studying your last two. I swim med when I turned in. The styrene down to mute. And can learn a pole that sunk he died.
When a Canadian corporation pays dividends, one of the first questions it must ask is where the shareholder lives. The shareholder's residency is extremely important because it determines how the dividend is taxed, what reporting forms are required, and whether the corporation must withhold tax before making the payment. Let's first look at a Canadian resident shareholder. When the shareholder is a resident of Canada, the corporation generally pays the full amount of the declared dividend. No withholding tax is deducted before the payment is made. At the end of the year, the corporation issues a T5 slip, which reports the dividend income. The shareholder then includes that dividend on their Canadian personal income tax return and may be eligible for the dividend tax credit, depending on the type of dividend received. Now consider a non-resident shareholder. The process changes significantly. Before paying the dividend, the corporation is generally required to withhold a portion of the payment as Part 13 withholding tax. Instead of receiving the full dividend, the non-resident shareholder receives the net amount after the withholding tax has been deducted. The corporation is responsible for remitting the withheld tax to the Canada Revenue Agency. Because the reporting requirements are also different, non-resident dividends are not reported on a T5 slip. Instead, the corporation uses an NR4 information slip to report the dividend and the amount of withholding tax that was deducted. In many cases, Canada's tax treaties with other countries may reduce the standard withholding tax rate, but the corporation must determine whether the shareholder qualifies for treaty benefits before applying the reduced rate. The most important point to remember is that the dividend itself may be exactly the same, but the corporation's responsibilities are completely different depending on the shareholder's residency. A Canadian resident generally receives the full dividend and a T5 slip, while a non-resident usually receives the dividend after withholding tax has been deducted and is reported on an NR4 slip. As a tax professional, one of the first things you should verify before processing any dividend payment is whether the shareholder is a Canadian resident or a non-resident. That single piece of information determines the corporation's reporting obligations, withholding requirements, and overall compliance with Canadian tax law. When a corporation pays dividends to a non-resident shareholder, it has additional tax responsibilities that do not apply when paying dividends to Canadian residents. Instead of simply paying the full dividend, the corporation must first determine the shareholder's residency, because that decision affects every step that follows. The process begins just like any other dividend payment. The board of directors declares a dividend after confirming that the corporation has sufficient after-tax profits available for distribution before the payment is made. However, the corporation must determine whether the shareholder is a Canadian resident or a non-resident for tax purposes. If the shareholder is a Canadian resident, the process is straightforward. The corporation pays the full dividend directly to the shareholder, and at the end of the year, it reports the payment on a T5 information slip. If the shareholder is a non-resident, the process changes. Before making the payment, the corporation is generally required to withhold Part 13 withholding tax from the dividend. Instead of receiving the full amount, the shareholder receives only the net dividend after the withholding tax has been deducted. The amount withheld does not stay with the corporation. It must be remitted to the Canada Revenue Agency on behalf of the non-resident shareholder. In many situations, Canada's tax treaties with other countries may reduce the withholding tax rate, so the corporation should verify whether the shareholder is entitled to treaty benefits before applying the withholding. After the payment has been made and the tax has been remitted, the corporation completes its reporting obligations. Unlike Canadian resident dividends, which are reported on a T5 slip. Dividends paid to non-residents are reported on an NR4 information slip. The NR4 reports both the gross dividend and the amount of withholding tax that was deducted and remitted to the CRA. The key concept to remember is that the corporation follows two different reporting paths depending on the shareholder's residency. Canadian residents receive the full dividend and a T5 slip. Non-residents generally receive a reduced payment because withholding tax is deducted first, and the corporation reports the transaction using an NR4 slip. Identifying the shareholder's residency before processing the payment is therefore one of the most important steps in ensuring the corporation complies with Canada's international tax reporting rules. The final comparison between resident and non-resident shareholders highlights an important principle in Canadian corporate taxation. The same dividend payment can have completely different tax consequences depending on where the shareholder resides. For that reason, every corporation must determine a shareholder's residency before paying a dividend. For a Canadian resident shareholder, the process is relatively straightforward. The corporation generally pays the full dividend without withholding tax, issues a T5 information slip, and the shareholder reports the dividend on their Canadian personal income tax return. Depending on the type of dividend received, the shareholder may also benefit from the dividend tax credit, which helps reduce the overall personal tax payable. For a non-resident shareholder, the corporation has additional compliance responsibilities. In most cases, it must withhold Part 13 withholding tax before making the payment. The shareholder therefore receives the net dividend after tax has been deducted. Instead of issuing a T5 slip, the corporation prepares an NR4 information slip, which reports both the dividend paid and the withholding tax remitted to the Canada Revenue Agency. It's also important to remember that Canada's tax treaties with many countries may reduce the withholding tax rate before applying a reduced treaty rate. However, the corporation must confirm that the shareholder qualifies for those treaty benefits and maintain appropriate supporting documentation. From a compliance perspective, corporations should always follow a simple checklist before paying dividends. First, confirm the shareholder's residency. Next, determine whether withholding tax applies. If tax must be withheld, calculate the correct amount, remit it to the CRA on time, and prepare the appropriate reporting slip, either a T5 for Canadian residents or an NR4 for non-residents. As a tax professional, this is one of the most important practical checks you can perform. A mistake in determining shareholder residency can lead to incorrect reporting, missed withholding tax obligations, interest charges, and penalties. Simply asking, "Is this shareholder a Canadian resident or a non-resident?" at the beginning of the process can prevent many costly compliance errors. The key takeaway is that dividend payments are not handled the same way for every shareholder. Canadian residents generally receive the full dividend and report it on a T5 slip, while non-residents usually receive a reduced payment after withholding tax and are reported on an NR4 slip. Correctly identifying shareholder residency is therefore the foundation of proper dividend reporting and international tax compliance.